Welcome, everyone. I'm Missi Hoffman, the Director of Operations here at Avenues to Wealth, along with our financial professionals, Jonathan Neher, Diane Watson, and Zachary Lind. We wanted to take a moment to go over some of the questions you may have currently with these markets. I'm going to go ahead and start with my first question, and I'll send that over to you, Jonathan. Have you seen this type of market volatility in the past? And if so, how is it different in today's environment?
I started in the business in November of 1997. I had a couple of good years. Markets started dropping in March of 2000. And the next 3 years, 2000, 2001, 2002 were pretty tumultuous years. So those were a couple of pretty bad years that we saw. Markets were just starting to get back. People were starting to feel like the glory days of the late 90s were back again. And then 2008 hit once again. So we have definitely seen this. Plus, since then, we've seen a couple of blurps in a few years that we did see some negative returns in the market. So there was an interesting stat I just looked up. When I started in the business, the Dow Jones was at 7,909 points. Today, it's at 32,516. The S&P 500 was 971. Today, it's 4,067. So it's pretty big increases since that point in time. As far as in today's environment, from time to time, you do hit these black swans in the markets. I think a lot of it is being patient. The pandemic has created a number of different challenges in the markets. We have seen for the past number of years, interest rates declining, and now we're starting to see a change with that. But I think overall, as I've seen over the past 20 plus years, if people are just simply patient, sit back, you'll be rewarded for it.
You know, just to go along with what Jonathan said, just on a personal note, we have been here before, and I know my husband and I invested $50,000 in 2008 and proceeded to watch the money drop just like it is right now. But I will tell you that we were able to, then the market swung back. And so we were able to actually pay for 2 weddings. We actually took another 20,000 out, and we have 25,000 left because the market turned around. So I agree with Jonathan. We've been here before. It's scary. But it's something that I think if you wait it out, that's usually successful.
On the flip side of that coin, I've been in the industry since 2017. So even in the last 3 or 4 years, I mean, in late 2018 Q4, there was a 20% drop from its peak. In 2020, the market's dropped 34% in 33 days. This time it's a little different because those both had quick turnarounds and quick recoveries. Like Jonathan said, we have rising interest rates right now and high inflation, which you probably won't see too many times in your life. So it's a little bit different in that aspect, but we'll keep beating the same drum here and just say, stay your path and stay in.
And Diane, I'm going to send the second question over to you. How would you describe what's currently happening with supply and demand right now?
You know, supply and demand. So basic economics, it's all based on supply and demand. And I think what's going on now is that in our economy, when the pandemic hit, the government helped people put money out there so that people would be able to survive, help people that got unemployed, so that we all didn't lose money and didn't end up homeless. So our government did that, which means that we actually people have money, a lot of people have money sitting in the bank, just in cash, so they can still buy things. And that's the demand side. Now, other countries didn't do what we did. And for example, China shut down, Vietnam shut down. So a lot of the countries that actually produced our supply shut down. So it cut off our supply chain. And so we still have this demand because we do have that money. The supply's not there. And so that's kind of put us out of equilibrium on the supply demand part.
And Zach, what's your take?
Yeah, so to go off what Diane said, it was like throwing jet fuel on a bonfire when the world governments decide to shut down factories, tell everyone they can't work, and the US government giving people money so that they could live, buy food, pay rent, all that stuff. Well, you know what? They also still wanted to order other things too. We tend to have excess money here in America, so we were still buying clothes and iPhones and all that stuff. But when you shut off the world economies like a light switch, it's hard to just flip them right back on. So now we have a huge demand for supplies that we're backed up on in a couple of years.
And Jonathan?
Yeah, I think with that as well, we had a lot of stimuluses that were coming in to the country, into this country, into our economy. People had extra money. They weren't traveling. They weren't doing things like that. As was mentioned, even in this country with the pandemic, we just didn't know that much about what was going on with COVID at the time. And I think everybody was nervous. And so it just backlogged everything. A lot of that has not fully been resolved. We continue to have challenges with that. And I think that is one of the big components that continues to make the economy struggle here a little bit. One thing about the demand is still very high right now. People are still doing things. People are still building houses. People are still doing projects. In this country, we still consume a lot of goods. And I think we'll kind of touch on this in a bit, but that demand is one thing that is still positive for the economy right now. It's just getting those goods here so that those things can continue on.
Zach, the next question is for you. How are the markets affected by the rise in inflation?
Yeah, so the inflation can be a leading indicator of what the economy is going to do. So when inflation's high, people are most likely going to spend less on discretionary spending. Those are the iPhones, the TVs, versus the luxury items. Even though right now demand is still high, it's something that maybe in the future is saying, okay, things are going to slow down quite a bit. Corporate profits are going to be less because they're not selling as much, and just people are not going to buy as many things that they don't need. So it's going to have an overall effect on the whole economy.
Jonathan, what would you like to add? You're on mute.
I would say too, inflation, as is mentioned, will slow down what people are spending with that. And, inflation, we really have seen minimal inflation over the past 5 to 8 years. In fact, through certain periods, we've actually seen some deflation. We saw gas prices over $4 a gallon back in 2008. They came down. We were seeing under $2 a gallon in gasoline. I think we tended to get a little spoiled in that sense as well. But certainly it will slow down what people are spending right now.
And I think people have to know that inflation is just part of the cycle. It's not an anomaly. There is the economic cycle. Inflation is part of it. Is it high right now? Yeah, it's the highest it's been in 40 years, but it's not necessarily unusual. So, and then, like they said, it's going to top out and it's going to slow down. So it's not something that's going to take off forever.
and I'm going to add something to that too. The average rate of inflation has been about 3% over the past 30, 40 years. We just haven't seen it, like I said, for the past 7, 8 years. We've kind of been spoiled with that. And many economists feel like we've perhaps peaked with inflation. We hit 10% earlier this year. We've started seeing that come down, and I think we will tend to see that come down. Obviously, we don't have any crystal ball on that, but I think as the Fed is starting to raise interest rates, that should help to theoretically bring down the issue of inflation.
My next question, how is the housing market affecting the financial industry? Jonathan?
People continue to buy and build, which has been a good thing for the economy. I think part of what has occurred with the housing market, to build houses, it's cost more because of the supply and demand. We have not had the supply of building materials. In late 2020, early 2021, we saw building materials skyrocket. But it's just like anything, supply and demand. When the supply is not there, but the demand is, prices rise. When the supply is greater than the demand, then prices decrease. So we continue to see that, but with rising interest rates, that will slow down. And we're already starting to see that slow down quite a bit, because people are getting to a point, the house values have increased dramatically over the past couple of years. Plus interest rates rising, it's starting to price people out of the market. Yet that being said, it's kind of interesting that we've also seen a lot of people coming in with cash buying houses. I haven't read this, but I think in my mind, what I'm seeing is as interest rates rise, bond values go down. So if people, a lot of people that are retired tend to have a lot in bonds, because a lot of times their thinking is, well, bonds are safe. I won't lose money in bonds. And that's not true. The past, again, 30, 40 years, we've seen interest rates going down and bond values work inversely. They go up. And we're now in a point, a lot of your longer term bonds, your 20, 30 year term bonds have lost 17% year to date, which is pretty dramatic for people that maybe don't think that bonds lose any money. But I personally feel like a lot of people are cashing out of that, taking cash and buying houses, because I think a lot feel like the housing market would be a little bit more stable. Maybe they can get a little bit more appreciation than they would in bonds right now, plus that income that would be coming in from rentals. We're just seeing a lot of houses become rentals right now.
And Diane, what's your take, your perspective?
You know, honestly, Jonathan, you said it so well. I think that the market is still strong. The housing market is still strong. And even as interest rates go up, it will slow down, but I still think it's going to stay pretty strong. And as far as on the investment side, you know, whether you invest in rental properties, there's other options to invest in real estate. So as far as the bond market not being a great place to be, there's other options that actually a strong real estate market kind of lends itself into an investment. So there's definitely options out there.
Yeah, the housing industry played a big role in the 2008 recession, but I don't think this is the case for 2022. This is directly coming from the lack of new housing starts in the last decade. Like John said, it's just supply and demand. So we're way behind where we need to be. And also it's kind of enticing for clients to see what the housing market has done. I mean, you can get some pretty good gains with your houses. I mean, the prices are increasing pretty quickly. And since there's a big shortage, a lot of people don't think it's not a bubble, it's gonna burst, it's not gonna decline, it's just maybe gonna slow down. So I think people are looking at that as a good investment opportunity right now.
My next question, I'll direct to you first, Diane. What would you say to your clients who are nearing retirement or at retirement in this type of market?
I think the first thing you need to do is really get a handle on what your assets are, what you're spending, what you would want it to be in retirement. And I think you need to look at your whole portfolio to help make decisions. If you don't know what you have, and then also what you're going to need, I think it's hard to kind of come up with a long-term plan. And so I think, like I said, just sitting down with an advisor just to say, this is what we have right now. This is what we'll need in the future. And that way you can look, there's different investments out there. And I think you also have to consider Social Security. You need to look at that as part of that. There's retirement. If you have a 3-leg stool, Social Security is a part of that. It's one of the legs. So you really need to look at every piece and like I said, figure out what your spending is, what your goals are to create that long-term plan.
Zach?
Luckily for us, most of our clients nearing retirement are already in more conservative portfolios, as they should be. And so they're not feeling the full force of these market downturns, but even like a little loss for these clients are not fun to see. And a big part of our job is to educate the clients and show them how we change portfolios over time and stay focused on their goals. So these market conditions are actually a good time for us to show clients how their portfolios have performed this year compared to the other indices. And it just scares clients because for months they see bad news flashing across the news screen, but it's comforting when we show them how we've updated and changed portfolios over the years to be more conservative for times like this.
And I would add to that too. I go back to the late 90s. We had a tremendous run in the tech field. And we saw so many people get wrapped up in that they lost all common sense as having diversified portfolios. Like, oh my gosh, I can make, 20 to 100% return in the tech field and in tech stocks. And so they got out of that balanced investing. I would say a little bit of greed. Warren Buffett says it the best: be greedy when people are fearful, but be fearful when people are greedy. And I think that is very important, that as you get close to retirement, you need to have a balance. And I think we believe very strongly in more managed portfolios. I think people, there is a shift. Right now, we've seen the past number of years, we've seen a tremendous increase in growth-oriented stocks, in tech stocks, but we're starting to see that shift. And I think people need to see that shift and make those changes as interest rates rise, as inflation is a little bit higher. There have to be some changes to portfolios. Instead of long-term bonds, very short-term bonds, or loan obligation situations that provide income, things like that. And I think one thing too that is very important that we try to implement with our clients is, one, planning. How is potentially higher inflation going to affect their portfolio? But two, creating maybe what we would call a bucket system. Okay, you have money in bucket one that has no risk to the markets. That's your cash bucket. Yeah, you're not earning a lot, but you're not going to lose anything on that. But then gradually over other buckets, maybe increase returns. There are programs out there that have what we call stop losses. In other words, will help to reduce any losses on the downside. And I think using some of those tools, that maybe your 10+ year money, that's going to be your most aggressive money. And then you're refilling the buckets as they deplete. I think when it comes to retirement, that is extremely important, because the biggest concern is that people will run out of money in retirement. or that the markets decrease it. And I'm going to go back to the 2000 range that the NASDAQ market was down over 60%. And I saw a lot of people getting greedy with that. And unfortunately, there's a compounding effect that when the markets go down and you're drawing money out of that as income, it's going to drive the value of those portfolios down even greater. And I saw so many people have to go back to work back in 2002, 2003. So I think as retirees as people get close to retirement or retirees, you got to be very cautious and many times implement some different strategies as well.
Well, the majority of us have heard the old adage, buy low, sell high. Zach, what are your thoughts on buying low right now?
Well, Jonathan stole my idea to use Warren Buffett for this segment, but there's tons of articles out right now saying Buffett is buying big while stocks are down, showing all these different companies he's buying. And he's not like the regular individual retail investor that most of us are, because we buy and sell on emotion. So right now, people are scared. They see everything going on in the news. They're scared. They think the market's going to keep on dropping. So they're selling after they've already had their 10, 15, 20% loss. But data shows that's not the time to do it. You need to follow people like Buffett who make logical decisions and not emotional decisions in times like this, and buy in these buying opportunities.
Jonathan?
One of the things that people forget too, and I'm going to say a lot of people are investing in 401ks in their company retirement plans. We're kind of in grounds that a lot of younger investors perhaps have not seen. And one of the things I think we need to stress is when people are putting money in regularly, whether it's bi-weekly, bi-monthly, monthly, whatever it might be, sometimes you're going to be buying shares at higher prices. Well, when those prices are higher in mutual funds or stocks, you're buying less shares with what you have and what you're putting in. But when prices are lower, you're buying more shares because they're on sale. It's what we call dollar cost averaging in the industry. So you end up having a lower average than buying at peak points. I always tell clients, ultimately, in my opinion, your goal is to buy as many shares as you possibly can until retirement. And you do not have a loss locked in unless you sell. And emotion is very involved when it comes to investing. And I've seen too many people shoot themselves in the foot. Going back to 2020, people kind of got afraid because of the pandemic. And I saw people that went to more conservative portfolios. They ended up the year, a lot of times, negative to flat. Whereas the people that stayed put, yes, they were down 15, 20, 25%, but many of them ended the year up anywhere from 20 to 50% through that period of time. And I agree. We buy cars on sale. We buy clothes on sale. We try to buy food on sale. Theoretically, we should be doing the same thing when it comes to investing.
I'd love to hear your side of this, Diane.
You know, it's funny. You both did such a great job, because that's, you know, it's scary. It's scary to look at your portfolio and see that it's dropped, and it's dropped quite a bit, partly because the last 10 years, our portfolios have gone up, and except for, you know, a little here and there. So to all of a sudden see this definitely makes you want to panic. But if you don't need the money today, like Jonathan said, you don't record the loss until you take the money. So now would be the time to say, you know what, just going back to things being on sale. If you like, you know, if you like to shop, if you can get more bang for your buck, you can get more shares for your money. It's actually a win. And that goes back to $2 dollar cost averaging. Sometimes it's going to cost you a little bit more. Sometimes you're going to get more shares for your money. Like Jonathan said, the more shares, the better. Especially if you're looking at portfolios and you have that diversification, you're looking at companies that really do have a good track record. There's a good chance they will turn around, and now the shares that you have are going to be worth more. So just hang in there. Don't panic.
Absolutely. Kind of going off of that, Jonathan, is there any way you can predict when the markets could bounce back?
I always tell my clients, I have to laugh about this a little bit, that my crystal ball was confiscated when I went through the TSA through the airport. So we don't have a crystal ball anymore. But I would have to go back to my past 24, 25 years in this business. As I mentioned earlier, when I started in the business, the Dow was 7,900. Today, it's 32,000 and change. We have seen the markets go up. We have seen the markets go down and bounce back. People have gotten nervous and jumped out of the markets when they feel a certain political individual is in control of the markets, things like that. But ultimately, I don't care who's in office or where we're at, the markets have continued to go up. And I think people just need to be patient with the markets.
Diane, what about you? Do you have a crystal ball?
I wish we had a crystal ball. I would love that, but we don't. And all we can do is look historically and kind of see what's happening. We've been here before. We've been here in the 2000s. We've been here in 2008, 2009. And back then, when the banks were failing and it felt like the end of the world. Well, all of a sudden, then the next, I don't know, the last 10 years have been terrific. So I think that I just think that historically it's gone up. It has its glitches, it has its down. Try and limit the amount of loss, but yeah, just stay strong. And I go back to diversify. Just make sure you diversify that portfolio.
Well, while you two are working on a crystal ball, I'm going to maybe work on a time machine. I spent a lot of my day listening to CNBC and a lot of other economists, and you can listen to 100 economists a day and they all have different prediction on when to buy, when the downturn is going to end. So no one knows. I mean, there's leading indicators, you can take guesses, you can maybe get close, but honestly, it's just kind of stupid if you think you can time the market properly. So that's, like I said earlier, that's a big reason why we try to educate the clients, because we don't want people getting out and trying to get back in. That's when you lose more than you would have if you just stayed in. So, and I also go back to what I said earlier, again, show data, show statistics, show the clients that the markets always come back. I guess we don't know what the future holds, but so far it's been true.
I want to add one thing to that too, is people a lot of times just think markets go up, and they don't. They come down a lot of times as well. And I would say all four of us are invested in the market. And I'm going to say, I hate it. You know, I hate seeing my clients' accounts go down. I hate to see my accounts go down. None of us like it. But there are some statistics too I want to bring out that typically we will see a decline in the markets of 5% about every 3 years. I'm sorry, 3 times a year. We will see a decline of about 10% or more about once every 12 to 18 months. We'll see a decline of 15% or more about once every 3 years, and a decline of 20% or more about once every 6 years. So it happens. Between 2000 and 2009, they kind of called that the lost decade. The S&P 500 was flat to slightly negative through that 10-year period. Now, from 2009 through 2019, the S&P 500 has been on a tear. We've seen an average of about 14.5%. If you average over that 20-year period, the average return on the S&P 500 has been about 7.5%. So I think people need to also have a realistic view of what the markets do, and that there are ups and downs. But again, ultimately, people are rewarded. Even if we only average 7.5%, that's a heck of a lot more than what the bank accounts have been paying.
And the final question that I have for all three of you, and I would like to address Diane first, is do you have a couple of takeaways for someone that you are consulting who is concerned about what's going on in the market right now?
I do. I think that I understand the concern. It's a uncomfortable time. I think it's kind of a stressful time. But then I'll also say that we have been here before. This is how a market cycles. When the media says, hey, worst inflation in 40 years, yes, but inflation's normal. And then they are working to get it back down to at least a reasonable level. I think when people worry about, oh, we're going to do the bubble again like 2008, 2009, the housing bubble was a whole different situation. So I think getting educated and learning as much as you can and talking to experts will help ease people's minds. So that would be a recommendation I would have. Definitely, because the more you know, I think the less panicked you'll feel. And also look historically what's happened. Like I said, we've been here before, and the market has definitely done better than it did, 10, 20 years ago.
And Zach, what's your take?
Yeah,
Your takeaways for your clients?
Many of my investors are emotional thinkers, just like everyone else. They like to make moves based on their emotions, like being scared from what the media is telling them, or on the flip side, when they see a big Bitcoin rush, they get greedy and they want to buy into Bitcoin. Or it goes both ways. They always using their emotions to make their decisions, which is not the way to go. So we educate, we show data, two things that are hard to deny, but yeah, we just make sure the client stays on the long-term goals and just don't let them make any emotional rash decisions. Is probably the best thing you can do for clients.
And Jonathan?
The founder of Vanguard, John Bogle, after 2000, 2002, and 2008, made the comment, we will see another major downturn in the market. We just don't know when it's going to be. And so I think there's different strategies for different investors. Are you a buy and hold individual? Are you tend to be more of a strategic investor that maybe kind of a combination of buy and hold, but then making some adjustments along the way a little bit, or more tactical investing? Those are all different ways that we implement with clients, sit down and see what works best for them. I think, again, the bucket system that I mentioned earlier, especially for those that are getting close to retirement or are retired, can add some peace of mind. I'm going to go back to the emotion. Investing is extremely emotional for a lot of people. Unfortunately, I have seen way too many people buy high and then sell low, again, shooting themselves in the foot. I think people need to understand a little bit more how investing works. If investing was everybody's thing, we wouldn't have a job. We have a job because a lot of our job is hand-holding people, helping them get through this period, assuring them. And another thing I want to caution too, and I'm going to go back to Warren Buffett. He has a saying, pigs get fat, hogs get slaughtered. Don't be greedy when the markets are here. Now's the time to pick up extra, buy along that way, but don't let emotion get in the way of making good financial decisions.
Does anybody else have anything they would like to add before we wrap up? Well, Jonathan, Diane, and Zachary are always happy to have those one-on-one conversations with you in regard to your specific needs and questions. So feel free to reach out to our office at any time to schedule a meeting. Thank you all for being a part of our Avenues to Wealth family.